Hello everyone, welcome to Just Invest Today. And today we're talking about Ray Dalio. You are missing the best opportunity ever right now. Do you remember the March crash that everyone was afraid to invest? They were scared, they were running for the hills. Guys, if you didn't make 50-60% returns last when the whole March crash happened, with the whole pandemic, guess what? You have another huge opportunity to make right now lots of money because people are scared, they're fearful, and that's the perfect opportunity to invest. So let's listen to Ray Dalio quick. But before we do that, please like this video, subscribe down below right now. Subscribe. Thank you. I'm on the road to 1,000 subscribers.
So it's an exciting part of the world. It's a part of the world that one can't neglect, and not only because of the opportunities but it provides, but you lose the excitement if you're not there. And so our objective is to be there both economically and investment-wise. I've been going to Singapore for nearly 30 years.
So there you have it. You're missing out on a huge opportunity. He's going to be there investment-wise. You guys have to understand the times to invest in the market is when there's max pessimism, and that's what we're seeing with China. So you have two market crashes. You had two market crashes in under 3 years, and people are not seeing it. Look at this chart. These is QQQ, the best US companies compared to the best Chinese companies. So the best Chinese companies are in the red. The best American companies are in the green. And look how it's always been following perfect from 2019 to 2020. Even going back, it would be following exactly the same. 2020, 2021 is the huge divergence when Xi Jinping came in and had all the rules and regulations. And look at the divergence. The QQQ is at 396, and look at the ETF for the biggest Chinese companies at 47. So are you telling me right now the biggest companies in the US are like 50-60% better than the biggest Chinese companies like Alibaba, PDD, like JD.com? And even though China's market economy is growing way faster? See how it doesn't make sense, and this is just all fear, this is all just pessimism, and that's when you're supposed to invest. You're not supposed to invest when everything's gloomy, everything is rosy, everything has been good going on with China. Where were all these VIE structures, where are all these rules and regulations back in 2017, 16, 15? People still investing in China, but the rules are becoming more sufficient for China, and people are afraid of that. So let's look at the best companies in the US. Apple, Microsoft, Nvidia, Adobe, Broadcom, PayPal. All strong, amazing companies. Intel, all strong, amazing companies. But are you telling me these companies are all better than all the best Chinese companies? Let's go to all the best Chinese companies. Tencent, JD.com, Middle One, Alibaba, Pinduoduo, NetEase, Trip, Baidu, Full Truck Alliance, Bilibili, JD Health. You're telling me those companies are 60% better than all the Chinese companies? No. So we just witnessed our first market crash back in March, which was a huge opportunity. If you did not make 50-60%, you were missing out. You were afraid. And that was the perfect time to invest. This is the second crash that they're giving you under 3 years. If you are not seeing this, I don't know what you are seeing in the market. Look at this new article by BlackRock. China regains favor with investors who deem India overvalued. In the change of tone over the world's two biggest emerging markets, global investors overseeing billions of dollars are slowly starting to favor China versus India. See, that's the thing. People are realizing how undervalued China is compared to all the other markets like India, like South America. But even though that, China still has the biggest, most dominant companies, but people are favoring these other markets and they're not seeing it. BlackRock has upgraded the Chinese stocks as policy hurdles ease, saying the time to position in China is now, and I agree with that. While trimming the exposure to India equities, they both downgraded Indian stocks recent days, with former upgrading offshore Chinese equities at the same time. Valuations are the key rationale as the losses triggered by Beijing wide-ranging regulatory crackdown have made Chinese equities relatively cheap, and that's the biggest thing. China is selling at 13 times forward earnings. Can you imagine that? And these companies are growing 20%, 30%, some even 40% earnings revenue growth, and they're selling at those prices, 13 times forward PE. You'll probably never see this again until like a while down the road. So if you think about it, are these Chinese companies gonna go out of business in 5 to 10 years? Are they gonna get bigger? Are they gonna be more dominant, stronger? If the answer is yes, then you are missing out on this boat. If you're seeing all the VIE structure risk, you're seeing all that international regulation and Xi Jinping's risk, I understand your decision. But what I'm seeing is a major opportunity to invest compared to all these other economies like India, South America, and China has the biggest company. So the wide gap in valuations, like valuations for Indian stocks have soared past their Chinese peers. And everyone knows that's not the case because the Chinese companies are way more dominant, they're more efficient, they have better managers. For the world's largest asset managers, the positive sentiment is based on the view that the monetary policy in China will likely be accommodative next year and the economic growth could be better than expected. Because remember, there still has a lot of supply chain issues, there's no traveling in China, there's all these power issues, there's Evergrande. So all these things are making the China's economy look bad. But what happens when that reverse? That's not going to be there forever. So China right now is so underweighted, so undervalued compared to any other market. Southside analysts also seem to agree. The China index is seen advancing 39% over the next 12 months. 39%, and this is what you might miss out. While the Indian counterpart is estimated to have less than half of that upside, according to analyst estimates compiled by Bloomberg. So there you guys have it, man. What do you think about this? Am I right? Am I wrong? Tell me what you think, man. I'm seeing this as a second market crash, another opportunity to make 50, 60% looking out 5 to 10 years from now. So tell me what you think. Leave a comment, like, comment, subscribe to my channel, and I'll get back to you in the next video. Peace!